Stock market traces its origins back to 12th century France, where some of the world's first brokers were trading debts of agricultural communities. However, the first joint stock company to be traded on stock exchange was the Dutch East India Company, founded in 1602, which was traded on Amsterdam Exchange. In fact, the Amsterdam Stock Exchange was established by VOC for dealings in its printed stock and bonds. VOC was a multinational corporation involved in production and trade of East Indian spices, shipbuilding, international trade, but most importantly, a pioneer of vertically integrated global supply chain. In order to fund its operations and expansion in Europe, Asia and Africa, VOC raised capital by issuing shares to the public. Because the capital was permanent during the lifetime of the company, investors that wished to liquidate their shares could only do this by selling their shares to others on the Amsterdam Stock Exchange, effectively creating blueprint for future companies and the stock market that we have today. By the late 17th century, VOC business grew and dividends were paid to its shareholders. More people got interested in trading VOC securities, resulting in increased volume, high liquidity, and formation of first trading clubs around the city. Around the same time when Amsterdam Stock Exchange was gaining popularity among traders, tulips rapidly became a luxury item, because of its intense saturated colors and the fact that it took few years to form a flowering bulb. Due to the plant's dormant phase from July to September, florists and tulip traders signed notary contracts to buy tulips at the end of the season, effectively creating the first futures contracts. This created the first recorded speculative bubble in history. At the peak of tulip mania in February 1637, some tulip bulbs sold for more than 10 times the annual income of skilled artisans. The Industrial Revolution created demand for more investments and economic expansion, which resulted in the opening of new markets around the world. London Stock Exchange was formed in 1773, and the New York Stock Exchange was founded in 1792, founded by 24 brokers who signed the Buttonwood Agreement, which set commission rate charged to clients in securities sales. European and American stock markets were used to raise capital through sale of debt and company shares. Public was increasingly interested in being an active participant in the growing economy and was looking to benefit from the appreciation in share prices. In the early days, trading, dark pools, lack of oversight, and manipulation created countless booms and busts that brought hardship to some and prosperity to others. During 1900s, investors and traders were introduced with new derivatives that fueled a couple of more market crashes. However, the main purpose and traditional structure of markets around the world remained the same: raising money to fund growth and distributed profits in exchange for fresh capital. Even after taking into account stock market crashes of 1929, 1987, 2001, 2008 and 2020, public markets are in continuous upward trend over a long period of time. Some market crashes take years to recover, but some take as little as few months. And this should not scare you away. You shouldn't be looking to get rich quick. There is no shortcut to wealth. Compounding your hard-earned money over a lifetime should be the aim. Stock market has been around for more than 400 years, and while today's markets and financial instruments are more complex than ever, this also means that there is an asset class or derivative suited for everybody, giving us more than ever an opportunity to invest and become co-owners of our future. If you like this video, please give it a thumbs up and subscribe.